Hey guys, good evening. This is Simon with Trade and Perform Coaching. Doing kind of a preview for the week. I'm getting back into the swing of making these videos. So I wanted to take before we enter the week, a big look picture at what not only ES but CL and GC, since I've kind of shifted to CL and GC being my primary trades. I wanted to cover them, but we'll start with the staples and we will work from there. So let's start with ES to begin with for the week. Kind of take a look at the overview, what we're looking for, and what the best way would be for, at least for me, to make money. So number one, I'm not bearish. Certainly, if I had to choose a side, I'd be more bullish than bearish, right? The market's just been on a tear. As you can see here, we're just on a monster tear starting back from all the way back into July of last year. We've gone through a consolidation. You can see here that we got above our initial consolidation, broke out, backside tested, shook the tree really nicely, took off, and you can see that we've just consistently have backside tested each of those areas, and each of those backside tests have held. Now you can see we've gotten pretty vertical, right? And again, remember, we're looking on the day time frame here. But one thing that's been consistent through each of these breakouts is we've come back to backside test each and every time, right? So I would expect at some point that we get a backside test between that 2275 and this 23, my dyslexics kicking in, but 2301 and 2275. But it's a long way from where we're trading right now, and I certainly don't expect that tomorrow. There'd have to be some kind of pretty big event to get us to push down that far in a straight line. There was a time in history where that could have been expected, but certainly not now. The other thing that we're looking for, that's a pretty classic sign of, people do ask me, well, if you're going to short, where's the best place to short? And if you'll notice, there's a consistent quality, and this takes place in most time frames. And again, the point of this, I don't make trading recommendations. This is for educational purposes only. Just a quick reminder, trading futures can be or is very aggressive. You can lose all your capital, and you should make sure that you're qualified to trade before you trade it. The purpose of the video is for educational purposes to help other traders along, right? So one of the things you're going to notice is that in order to have a breakdown, right, if you look at the old market, right, where we were in this large balance, let's see how far back we're going here. Let's make this 10 years back. So there we go. What you'll notice is that we, first of all, look at the quality of the tops, right? We tend to have this. See if I can't draw this out. We tend to have this rounding, long process, even when we were going to have these sharp drops, right? You'll notice there's very few push-ups. So we're going all the way back into 15, and we can go further back. Notice that each of these push-ups, right, have these rounding tops, and in general, before we get a significant correction, as we did from this point to this point, right? So notice how much time has passed. One of the things that I notice about day traders is that they, especially newer day traders, is they really want to consolidate things, right? Imagine if you said, you were up here and you're like, I know the market's going to crash and I'm uber bearish and I know it's going to go down. Well, you could have kind of started that rallying call here in December of 15, and it took you all the way till November of 16 till you saw any profit. The problem with that is, while if you have no skin in the game, that's an easy point of view to maintain. For those of us with skin in the game, for those of us who are trading with leverage, this is a very difficult road to hoe, right? And it kind of forgets about the basics of the in and out and give and take of the market, right? So a couple of things have to happen in order to get bearish. So first of all, generally we'll go through a period of distribution. We'll tend to get a rounding top. And you'll see this in here repeatedly. And even with the quality of the rounding top, it takes a while to get the reaction back to the downside, right? Even with that, right, you'll notice that we're nowhere close to forming any of this rounding type scenario, right? You'll also notice that we have to get below, right? And again, I'm using the daily chart, but this applies to almost all time frames. we have to get below the most recent point from which there was a significant push, right? And so if you'll notice all the way through here, and again, I'm specifically not going into great detail on any particular area because I'm trying to show you visually what this should look like when you break and when it kind of comes easier to come out and play from a day trader standpoint, right? So you'll see here, this had to get broken in order to be bearish, right? The next quality you wanted, if you thought you were going to get an extension to the downside, is what you don't want to have happen is you don't want the market to get back past the $50-60 retrace. Wow, I don't know how to get this off of drawing. Let's see if I can get this closed. Seems I can't. Ah, there we go. Brilliant, right? Okay, so what we're looking for here on the downside, remember, what I'm trying to address, the market's primarily up, right? That's the one quality you can see all the way through here, and that's a unique quality to the S&P 500, and I'm going to contrast that in a minute. So the first thing you'll notice when we broke down here, what you don't want to have happen is you don't want to get it back above the 50-60. So two qualities. You want to get back past below your last major point of up thrust, or the inception of the up thrust is the best way to do it. And so in this chart, right, that would be this point. When we're over here, it's these points. Until I get below these points, I'm not even interested. And then finally these points right here, I'm not even interested in shorting. And what you want to see, a picture perfect version of what you want to see there for the short. Now, I'm certain there's some very skilled day traders who can make money trading that balance range, because what this is here is a balance range. But for the majority of us, right, this is very hard, and clearly because of the nature of the S&P 500, it's simply easier to pick them off as they're pushing down and get the response back up. Now, what you'll see here is we finally break below not just one point where it lost up thrust, but the second point as well. So watch what happens when we come in here, we push down, and notice we push right back into the midpoint, the 50-60. So I'm talking about this location right here, right? We broke down, we came back to the mid, and look how beautifully the response is downward here repeatedly, right? Nice big fat stretch. There was plenty of money to make in here. So what does that story tell me? It tells me, hey, when I'm up here, right, as of right now, this is the last location, right? We're specifically right in here from which we launched. I would like to see the market below this point and then get a retrace back up for a potential short. Now, does that preclude the market from just coming around and just falling off the face, making a high and falling off the face of the earth? It does not. But it's really, really rare for the market just to make a new high, stop, turn around, and plummet straight down. Very rare. And trading is about being on the side of odds, not being on the side of what you want to happen. Believe me, what I would love to see happen is that this market completely melt, get underneath this 2078, backside test this 2076, and then give us nice big fat rotations like this over here. I would just kill for that to happen again. It's just not in the cards apparently right now, and so I'm going to wait, right? So I want to show you a contra picture now so that you know what to look for when the market is short, right? And to do that, we're going to go to a different market. So let's erase this. Let's get off of this. And then let's go to gold. This is as good a market as any. And let's just go with a new chart on gold, shall we? So let's pick a time frame, again, daily. It's easiest to see and easiest to learn from. So this is a great example. See, when I'm in here, assume you're a typical trader and you start to go, hey, we've really advanced here, right? This should be short, this should be short, and this should be short. And guess what? To a degree, all of these were correct, but notice how hard you had to work, right? So let's say you were short here thinking, this is the short now, right? And it was. If you notice, we broke below this last push up right here, and the short here worked to the downside, but it wasn't the short, right? It wasn't the short from this location down to this location down here, right? But there are some qualities within here that we're not seeing in ES right now that we do get in other markets that make our decision-making process a little bit easier in terms of determining when we want to short and when we don't want to short, right? So first of all, to remind you, ES has a mechanics underneath it, and Chris Laurie taught me this, and it's a very important concept. Remember, the bulk majority of pension funds and mutual funds have a mandate to be long only, right? So it's comprised of 500 companies, right? All 500 companies, in order to get that product to go down, there has to be a perceived systemic problem like there was back in, I think, 07, 08, right? Or 2001, right? Without that systemic problem, it's very hard to get the majority of people scared enough to go in and sell all their holdings, right? That is a very difficult process to get people to do. But individual commodities don't have that problem, right? Oil is kind of a two-way street. It's based on industrial demand for the most part, and there's a perception of supply and demand that's constantly being recalculated, right? So imagine you're up here, right? And you're going, well, gee, Simon, even in here, where do I want to short? Well, as I'm looking through here, I'm going to be like, well, I want to break below here. Now I want to break below here. Now notice, I'm going to spread this out a little bit as we're moving along, right? Notice that even though there we go. Even though we're in this process here of pushing to a higher high, right? Notice, and what I'm talking about specifically is this location and this location. Notice that on those two locations, right, we've actually broken the last point from which there was an up thrust. We haven't broken the key location. This is what has to get broken, right? This is the last point from which there was a major up thrust, okay? But we've broken a minor one right here. And then you'll notice, if you were patient enough to wait, you didn't have to figure out that it was short from the top. If you did, congratulations, no worries, right? But it's the harder way. If you simply waited, right? And there are ways to tell, but there's not easy ways to tell. You have to be quite skilled in getting that read, right? If you'll notice, you pull, now we've broken, you pull your 50-60 back. Notice that the market pushes right into the 50-60 retrace. Now, technically your stop is right here at the top, at 1306, right? This gives you a push into 1264, 1274, and a rotation right back to approximately, that looks like it's 1240, right? So from 1264 back to 1240 is 20 points. That's a lot of money. Not only that, but it took place almost in one day. Compare that to ES. So 40 points in gold, if you did that equivalent in the futures versus ES, that's $100 a point. That's $4,000, right? To get that equivalent move in ES, you would need a 10, 20, 40, 60, almost an 80 point ES move. Forgive my math if I'm wrong there, but I'm pretty sure that's correct, right? So this is huge that you can easily get direction, and you know that you have a two-sided market. Now watch what happens here. Notice that we never break, and this is a very important lesson for people to understand when they're looking to short. We never break the key last thrust, right? Notice how we come back down, we retest, we trap underneath the last swing low, trap back in, right? So you had to understand what was going on. We broke the minor swing low. We failed to break what I would call the significant swing low, right? Retested that over here, trapped back in from the last swing low, right? And what did we do? We shot right back up to test the high right here. So again, your key was we couldn't get below this point. And the reason why why that's important is because right now, if you go back and compare it to ES, we haven't even broken a minor swing low, much less the last major swing low. There's not a lot of reason, technically, in my eyes, to be bearish unless you're very skilled at both sides of the market. And unfortunately, in ES, there's just not a lot of range that the market's providing anymore like it does in gold, right? I'm going to continue with this thought process here in just a second. Just checking my messages. And that is frustrating. Give me one sec, guys. I apologize. Okay, great. So next, let's follow how this line goes along. I'm going to wrap this up in a couple of minutes. Right? You notice we push back up. This now becomes, right? Notice right here. This now becomes my new swing low right in here. Push up. This now becomes my last swing low right here, and this is going to play an important role in just a second. Now notice, I pushed to a new high, and notice this, see we've shifted here, and this concept, I'm always going over. Swing one, swing two, and then let's just call these all minor swings. I've got to get below in a substantial way, right? I've got to get below my last swing lows in order for me to say, yes, we have distribution. Yes, you can call this a bearish pennant right here. No worries. But you got to get below your last series of swing lows, right? And so that shifts from here to a minimum of these, right? So you can see if a guy kept trying to pound the short side here, he didn't have to. He didn't have to sweat it, right? Just wait patiently through this. You don't have to do anything more than that. Again, this is on a day time frame, so intra day, other things may have played out, but on the daily, right? On the daily, all you got to do is wait for the break, which you got right here, and I want to show you this. Remember, when you draw a 50-60, your correct stop is always a few points over the high. If you come in and you grab your retrace tool, you'll notice I keep mine set pretty much at 50-60, right? Notice we spike right up into that 50-60, reject out, right? And now notice this also broke this swing low, broke this last major upthrust, again measured by size, right? It broke this small series of swing lows up here, gave me a 50-60 back, and now finally we've broken this point right here. And if you'll follow along, right, and notice you didn't have to freak out in any of this process, right? All a good trader had to do was wait for this to get broken, wait for the break, and sit and wait like the wolf waiting to get his kill, right? And you got the move to the downside, right? And then we're going to try to go over just a little bit more. And if you'll work at it, you'll see this process play out in all time frames, right? So notice we now break all three of those, right? So watch what happens here. Start rolling down. And then finally, this brings us all the way back to Friday afternoon this week on gold. We push right up into resistance at the 50 retrace, and we are now rejecting down out of that in early Sunday trading, right? So what has to happen in order for us to get a move to the upside? Well, we flip it the other side, the other way now, right? So from where we are at right now, I know two things. First of all, this was the last point. This is my last point from which I had responsive buyers on the day time frame, right? This, I'm going to call this my invisible swing high, and I'm going to call this my true swing high because we actually spent some time trading there. It just wasn't wicking in, wicking out. So for me right now, right, I'm going to call this my major swing high. I want to get above this point and hold, right, in order to get a push to the upside, right? Additionally, right, in order for me to think, oh, are we bearish or do I really want to press? I know we've drawn into the bigger picture pressure, right? But if I get below this point right here, I'm going to come back and look for a 50-60, right? So imagine we swing down, break. I'm going to look for a 50-60 to possibly push me to the downside. A lot has to happen before any of that occurs, right? As of now, we have, this is the last point where we try to consolidate, right? That consolidation, they try to hold it there, right? So it's not really a swing, but I'm going to count this as the point from which I swing down. I've now broken above that point, right? And so the next thing I'm doing here in terms of, again, from the day time frame, and I do this on all in my coaching and in my trading, right? I'm now back over here and I'm going to go, let me see my setup with my additional indicators, mostly volume indicators, right? On a push into this location, right? That 5060, which right now is 1196 to 1180, right? I'm going to want to look for responsive buyers in that area for a push back towards the most recent swing high, right? So, and what's most likely to look like is if we push in, will be an initial push past the 5060, and then a decision point will have to be made. So I'm not going to go through multiple time frames. That's very confusing, right? But what is important right now, we pushed up into the 50 retrace after this big extended breakdown. We broke the last major point from which we swung up, right? That's bearish. This 50-60 back, right, has provided rejection. Now the question is, can we break this swing low and look for areas lower, or how does the market develop from here? In the first test, or the first major test, will be that 50-60 back, and see how the market responds. Of course, I'm a day trader, so I'm taking all this larger time frame stuff and breaking it down to the point of decision. And the idea is to use scalping techniques to enter into swing trades, right? So that's kind of the picture of what we have going on in GC. Let's take a quick picture of CL if we can. Let's say I have it here. And I'm not going to cover volume profile. I'm just going to cover the day time frame again and preparing for the week. Should have that here maybe. There we go. Okay. So the first thing you're going to notice is there's a huge problem with CL. And that problem is that we are in the tiniest range we have been in a long, long time. If you want to take a really big picture on this, you can go to give you a better idea, go to a weekly, and you can see this is just, it's ridiculously small. You get a good picture of just how much damage has become of CL. And the other thing that you'll notice is this is not the first time we've gone through an extended period where it's gotten really narrow. And I want to point this out really quick. It gets narrow here, right? It gets really narrow in here, okay? Gets narrow here, gets very narrow right in here, okay? And gets pretty narrow right here, right? But this, right, of all these examples of how narrow it's gotten, this is really, we had a little small example here, but this is really, it's drawn out and it's really incredibly tiny. So what that does is a couple of things. It changes the characteristics of how CL trades, right? Secondly, it changes the volume patterns on it and the overshoots and what rotation you're looking for to take a contra trade the opposite direction. So that's the first thing, right? Secondly, as we bring this down to a daily time frame, what you'll notice quite clearly is that this is the bottom of balance right here. This is approximately the mid, and this is about the top of the range, right? With a couple exceptions, we've pushed above, and we're basically, if you're used to trading the S&P 500, that's basically balance. Wait till it gets to the edges, pushes a little bit past the edges, and look for it to respond and swing back to the other side. So ideally, the worst place to trade balance is in the middle of the range. It's the hardest point to pick off, and that basically looks like this right now. Let's see if we can tighten this. Basically, in that area right there, that is the hardest place to put on a trade in CL right now. If you wait till you get away into the edges, right, what the market is doing in principle is it is pushing to the edge and pushing back, right, pushing to the top and pushing back to the other end of the range. If that was your trading strategy going back to December, right, you have absolutely killed it if you figured out this is what was going on and you are trading very, very well in that process. Most crude traders that I know are very disappointed because what they're used to is this, right? And you can see this is the range is really, really wide. The trend days here can be enormous, and we've just lost that quality. It almost has a flip-flop quality. If one day's up, the next day's down, and you have to remember that when we break out on CL, we are very likely to go back to trading ranges like this, right? And so if you're used to picking off trades at 30 and 40 tick rotations, you're going to need to push out to 100 and 200 tick rotations to keep your same success rate without getting run over. And it's just remember, you've got to trade what's in front of you, but don't forget what CL is capable of. I'm quite confident that we will break out of this range sooner or later, but it's in a real difficult position right now, to say the least, right? And so the other thing that I want to leave you with right now is on CL is notice, in order for any damage to occur, right, if you're bearish, you've got to get below, the setup is still the same. You've got to get below here, or you've got to get above and close above here. And there's one more caveat to that, right? Just like this was the old, see how this was the old swing high right here? It isn't enough for it just to kind of touch and close above. It's all right, but what you really want is a big, clear impulse move up like we got right in here, right? This is your impulse move to the upside. Again, this is on a day time frame, right? And then what you want to go back and do is grab your Fibonacci, even though a 50 Fibonacci is not a real Fibonacci number. Everyone uses it. And if you'll notice, if you push from high to low, right? Again, I'll remind everybody, your proper stop is behind the swing low. This is your impulse move up. And then we push down and you get a 50-60 retrace and a pop to the upside. It's a really pretty trade, and it's also, remember, historically in most commodity markets and currency markets, the first leg's the smaller leg. It's the second leg that gives you the big pop, right? So very important to remember. So I want to leave you with this last thought. There's never a rush to trade. Go back and look and see if a major swing low or a major swing high, or even a minor swing low or a minor swing high, have been broken on either side, right? Look for your retrace for your better entries, right? Simple stuff, right? Be patient and recognize if you're in a balanced market and you think, for example, that oil is short, cool. Wait for the break. You'll get a backside test and you'll have a beautiful short to the downside. If you think it's long, right? You don't have to commit energy here unless you're some kind of super huge fund, right? Wait for us to break above this point and capture the retrace back down for a continuation higher. It makes your life much, much easier. And if you're trading in this area here, remember the hardest place to trade this is going to be right in the middle of the range, right? So we've covered GC, we've covered ES, we've noted that ES is still in full bull mode, nowhere close to breaking any kind of significant swing low. Gold looks relatively healthy, right, on pullbacks and proper setups intraday. Looks like it wants to continue to make a push to the upside, particularly if you can get above 1250. It looks like 1280 to 1300 is certainly doable, right? And on crude oil, we're in the tightest balance that we've been in years, and you want to be a little more agile on your entries and exits, but very important, be aware that when it does break out, it can be nasty and hard and big in either direction, right? And you better would know which way you need that market to go in order to swim with it efficiently and not get run over. Anyways, my name is Simon. I mentor traders. I try to help other traders out as much as I can with the basics of trading, and I hope this helps. Anyways, have a great night. I ran way over. We will talk to you later this week.